We recently had a viewer ask a question about why it wouldn't make sense just to invest everything you have in stocks because those have the highest expected returns.
Right.
We'll talk about that on this week's episode of Friends Talk Financial Planning. Hi, I'm John Scherer, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan, Mermel. I've got a fee-only financial planning practice in Chicago, Illinois. And before we start talking about investing 100% in stocks and what the pluses and minuses of that are, please subscribe. We're trying to get 1,000 subscribers, and you can help. Thank you.
That's right. So let's talk about investing. And we don't focus on investing a lot because it's only one of the things that a good financial plan puts together. But I think it's a really great question as you take a look at, hey, over time, stocks have outperformed bonds, right? I'll pull up a quick thing here. This is over the last, almost 200 years. And it talks about what stocks do versus bonds versus gold. And you go like, oh, it's a pretty compelling story that stocks really do good during over time, right? And as a side note, I like this little graphic when people talk about gold and how that's going to be such a great, hedge against inflation, all those things. And gold has its place, but you look at over a 200-year period, and that's not such a hot return, right? So that's instigates conversation on the other side of things. Right. But why not stocks then, right? If we know, and we know stocks are risky, and this person said, hey, listen, I'm willing to go up and down, but my goal is to have as much growth as I possibly can have over time, right? So I'm interested to hear what you have to say about this, Bridget, but I thought maybe I'd just share my ideas and some of the communication that I have with clients and talk about why we don't typically recommend all stocks and where it can make sense. And one of the things here, I'll pull up a chart that compares, this is over 15-year periods, and maybe before we even pull the chart up, just say that the reason why I don't recommend that is we can go long periods of time and where stocks don't outperform bonds or cash, right? We looked at the first graphic. Hey, over 200 years, long periods of time, but long is like 50 years, 75 years, 100 years, right? So here, we'll pull up this chart where this is a study that goes back to the 1940s, right? And it compares the 5-year Treasury bonds, right? So a shortish term bond to the S&P 500 over 15-year periods. Right, so each data point is the trailing 15-year period with things, and take a look. Sort of in the middle bottom here, we've got the 0%, meaning if it's at 0, that means that stocks and bonds were exactly equal. These bonds, and if it's below that, that means that bonds actually outperformed or stocks did worse. Right, there's not an insignificant number of cases on this chart that are at or below 0, meaning stocks did the same or worse than bonds, with a lot more of up and down with things, right?
Yeah, and it's hard to remember this because in the last 10 years, maybe 15, since the downturn, stocks have been doing generally
really
great. Not every year, but it's been, we've had a nice run, and so it can be hard to even remember, when it wasn't like this.
Right. And it's a recency bias, right? Hey, what we think what happens, you kind of forget what happened 10 and 15, 20 years ago, 30 years ago, right? And the other thing about this is, one, we haven't seen it recently here. Actually, you take a look back on 2012 and 14, right? There were 15-year periods. The other thing is it's hard to think in 15-year time frames. You go, stocks have done well the last 15 years, but these time periods, remember, it's the previous 15. You go, oh, that's right, over a long period. I have a hard time remembering, what happened, yesterday, much less 5 years ago, much less 15 years ago, and how it looked, right? And so when you take a look at these longer term things and think about what this chart means, right? Think about going back 15 years. Think about where you were, where we were 15 years ago, and saying, listen, as of today, I would have as much or more money if I had just bought 5-year CDs as if I invested in the market, went through all the ups and downs of the tech bubble and the credit crisis and Phil and all these things and the ups and downs of that. I would have been the same thing if I just put my money into boring 5-year CDs or 5-year treasuries, right? And then maybe I've had more money over 15 years later. Right. You think about what that means. I mean, it's really this long term. You think, oh, I've got a long term time horizon. I've got 10 years before I need to use this money.
Yeah, 10 years.
And that just isn't. I mean, 10 years is a long time as individuals, right? Got 10 years ago, I had hair practically, right? But from an investment standpoint, these things can go for a long period of time. It's really hard to judge those or to internalize what that means when we're talking about 15 years ago. That you're 15 years from now, your money being worth less than it is today compared to being being in a cash, basically.
Okay, so let me use some examples.
Yeah, I love it.
So during when COVID started, the stock market went down 25%, and we had calls with clients. Mm-hmm. How you feeling? How's it going? Everything okay? And there was so much going on then that it was a great time to touch base with people, right? But most of the people, with the exception of one or two, didn't need to be talked off the cliff. Okay, but the thing is that turned around within like a few months. It didn't stay 25% down for a long period of time. Mm-hmm. Okay, recently the stock market was down 10% for like a year. And I got a call or two that was like, why isn't it high? It's always supposed to be high. And we do a lot of talking to people about the ups and downs. Mm-hmm. But you can understand that intellectually. But then when you actually see your bank account, you feel it emotionally. Yeah. And it might not feel good. Mm-hmm. So what you're saying is that I would have to endure this. If I'm a person, I would have to be looking at my bank account or my investment account for 15 years and see nothing happening.
That's the potential.
And that
right.
I would not be coming back to you if you were my advisor saying, hey, John, I don't believe in stocks anymore. Mm-hmm. This is giving me nothing. Mm-hmm. I'd be better off in a savings account. Mm-hmm. It would seem to me that it would be a rational conclusion. It wouldn't be a crazy idea to say that after 15 years. So that's what that's what I see. That's my reason.
And I don't disagree with you, but what you say is, hey, it would be logical to think I've been 15 years, right? Hey, 1, 2, 3, 5. Come on, guys, when's this going to get ahead? Right. But take a look at the data, right? Fantasy. You go no, it's rationally. What we need, what I talk with folks about is, if you're going to be, when you're in stocks, right, you need to be prepared that there are going to be 15-year stretches where you could have done better by putting the money in CDs. Is it most of the time? Absolutely not, right? Look at the chart. Most of the time, you're better off in stocks. Go back to that first chart we looked at. We don't need to pull it up, right? You have, $5 gazillion compared to $500 sort of thing, right? But there are times, and is it 10%? Is it 20%? I mean, something, you think about 20% of the time, you'd be better off just being in cash. Problem is, we don't know which 20% of the time it is, right, until after it's already done. And you think about, and we talk about, hey, does it make sense to even invest in stocks? Well, let's say if 20% of the time you're better off in cash or bonds, but 80% of the time you're better off in stocks. And when you're better off in stocks, you're much better off. You can sort of flip this conversation on the other side. We have some people say, let's just be all, it's all conservative. Right. We go, listen, 4 out of 5 years, we're going to be in really good shape. 4 out of 5 15-year periods are going to be in good shape. Right? So we need to bet on the one that's got the 80% odds of coming, but do we go all in on that and never look at anything else? Well, no, we got that 20%, 1 in 5 chances that, hey, it's going to underperform over a long period of time. It's just so hard to, so that's exactly sort of the same thing, the flip side of, or two sides of the same coin with things is, we have some person ask and love the questions. If you guys, as you guys have questions, love to hear those things, but why not all stocks? Because it certainly seems to make sense. And to the extent that you can be Rip Van Winkle and never pay attention to it for 50 years, yep, that's, that makes sense. The problem is it's just really hard to do that, and we don't know when those times are coming. And we talk a lot about on our show about just what are the facts, right? It's just hard to really understand or get clarity on what's going on out there. And I think this conversation shows listen, there are times and there are extended times, and it's a long period of time that you could be underwater, and knowing that helps, I think, to balance that side of, oh yeah, that's right, I forget how risky these stocks really are. Right. We're getting good returns most of the time, but we can go for, a decade and a half and be underwater basically, right? You think about how powerful that is, how emotionally powerful it is. You go, geez, I'm, comfortable with ups and downs, but I loved how you described, when we went through 2020 is down 25%, but then it's back in 6 months. We had conversations with folks back at that time about going back to 2007, 2008, 2009 in the credit crisis, where it went down 25% and then it stayed down and then it went down some more and then it stayed down. Right. And then think about what that means also. We look at a chart like we pulled up before, and it's sort of it goes down and then it comes back up. Well, we know that looking at it in arrears, and I believe that that's going to be the the case. But when you're in the middle of that, it doesn't always feel like, oh yeah, that's right, it's just fine.
Right.
And I go back to 07, 08, 09 when the market was down and it stayed down. Now we're 18 months in and it's still down 20, 30, 40%. And it's not like, well, my money's down, but everything else is fine. No, my money's down. Unemployment's at record highs.
Right. My income's low.
The oldest bank in America went out of business.
Right.
The largest insurance company in the world almost went out of business, had to be
Right.
bailed out. All these things are going on and my money's down. Now suddenly it's like, that's the thing. It's not
Right.
just, oh, my money's down. It's on a nice little chart, right? It's
Right.
a different feeling of,
Right.
the world's going to hell in a handbasket
Right.
and my money is down. And what are we going to do? Like, that's the stuff that's hard to think about in advance,
Right.
but it's useful to remember and look at these things so you can make good decisions.
Well, and those ideas are why, as people get older, we have less than so the 80-20 portfolio is generally the most aggressive that we will recommend. 80% in stocks and 20% in safe stuff, right? But as you get older, that's the reason why we expand the safe stuff, because you might need to go through these long periods and you don't have the resources to earn your way back into
That's right.
higher net worth. So that's why we recommend it. And it's been interesting for me in the industry because it seems like it gives people a softer ride and they appreciate it. So.
That's great. Hey, that's a great place to wrap things up. Again, we love questions from viewers. Please keep them coming. We love talking about things that are meaningful for you guys. And with that, I'm John Scherer, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan, Mermel. I've got a fee-only financial advisory practice in Chicago, Illinois. Both John and I are members of ACP, or the Alliance of Comprehensive Planners. You can check it out at acplanners.org to find an advisor in your area.
And don't forget, hit that subscribe button.